Hey guys, how's it going? It's Charlie Marr again, and today I want to kind of continue these last few responses or like reaction videos that I've been making, and I want to share with you guys another video, this time by Seth Klarman himself, and it's an interview by Charlie Rose, and it pretty much breaks down everything I always tell you guys, like everything I'm always preaching, trying to teach, trying to share with you guys the three stages, everything is just kind of confirmed by Seth here. And keep in mind, these aren't just random YouTubers or random people on TikTok or these furus, any of that. These are actual billionaires. And we're not even just talking about multi-millionaires. We're talking about billionaires. You're talking about Charlie Munger. You're talking about Seth Klarman. You're talking about Warren Buffett, and there's so many more. So I'm gonna go ahead and play this video for you guys. I'll see where I'll allocate myself right now. But yeah, let's go ahead and press play, and I will go ahead and share my thoughts as we go on this one. How do I make this full screen? Oh, I guess that's it for there. Where should I put myself? I don't want to be too obnoxious here. Let's go covered like, I guess around here. This should work.
And according to what I read, it's a book that's on Warren Buffett's desk, and you both are, great. I don't want to use the word disciples, but you're great followers of the teachings of Ben Graham.
I think it's probably on Warren's bookshelf under a pile of papers. I don't think Warren needs to read it anymore.
What was it, though?
I don't really know. I tried to write it to be accessible to the layperson or the professional entering the field, and so I tried to use layman's language and just make it accessible. It's certainly, the term is borrowed from security analysis, and it's meant to be in some ways an intellectual successor to Intelligent Investor, which was the more accessible of Graham's books. So I think it's just another book in that tradition.
More than that. So when they called on...
Maybe if people can't get something, they want it even more.
Well, there may be a lot to that. I think they call that supply and demand. Suppose you wrote recently the preface.
So, by the way, just to clarify, what they're talking about right now is the book Margin of Safety, the book he made, which is a very limited book. I personally have the actual copy of the book. I have a really good, clean copy. I think I paid like $3,800 for this. It's a very clean copy. And I just like to have the physical book, and I personally wanted it for myself. But this is something that you can find the PDF version online. There's many free versions out there. You could come across. I just like reading actual books. I don't like to read, like, especially kind of long books. Well, not that it's a big book on on screens. So that's just kind of what they're talking about when he's talking about the supply and demand, and like there's not that many limited books, and the book that Warren Buffett had on his desk, and how the terms and stuff he used is stuff that he learned from security analysis and the Intelligent Investor.
Preface to the new edition of Security Analysis. Is that the right title, Securities Analysis? What is it you want to say, and why has it remained, A, your lodestar, and secondly, sort of this remarkable, everybody knows, I've probably done more conversations with Warren Buffett than anybody alive, and we talk about it all the time, and how, his own Ben Graham experience and coming to Columbia and what it meant to him. Help me understand why this has been such a profound series of principles that have made you, in investments, who you are today.
First of all, I wish I'd met Ben Graham. I never was fortunate enough to do that. I think Warren captured the idea himself in his 1964 article, The Super Investors of Graham and Doddsville.
Right.
And in it, he talks about value investing's like an inoculation. You either get it right away or you never get it. And I think it's just true. I actually think there's a gene for this stuff, whether it's a value investing gene or contrarian gene. I think that everybody appreciates a bargain, but when the market's going down, most people overreact and get scared.
So this is something that I have come to realization like lately. I wanted to always keep this a secret. I didn't want to share this with people. I wanted to kind of keep everything I know just in my own little world. But I realized no matter how much you speak to people, no matter how much you try and teach them, you can show them everything, the equations, the formulas, the psychology, everything. Some people just don't get it and will never get it. It just doesn't click. I was fortunate enough that for me it clicked and it made sense and it's been working for me. And like it I always use the word common sense because that's all this is. This is just common sense and keeping it simple. It's slowing down the noise, slowing down the way you see the market. You're investing in companies. You're forgetting the noise with the charts. You're forgetting the noise with the price. The stock's price is not the company and the company's not the price. And it's like shocking to me how some people will this is something that I run into a lot is I buy a stock because I think it's a great value. I'm buying $1 for 50 cents, and people look at the chart and they're like, this is a dumb buy. Why would you buy this? It's been going down for the last 5 years. Well, because it's been overvalued for the last 5 years. It's not anymore. I'm focused on the numbers, you focus on the chart. Or the thing that they don't get is when we're buying these kind of companies, again, he said it himself. This is a contrarian approach. You're buying when nobody wants, when a company's distressed, when they're having issues, when there's regulations attacking it. The whole reason a stock becomes cheap and crashes and it's going down and there's a falling knife is because of those issues. You just have to ask yourself, are those issues solvable? Is it something you can reverse? Is it something that can be fixed? If you can, then the smart money is buying when nobody wants them. And that's kind of where I get a lot of hate. Or the other thing is when you buy $1 for 50 cents and it goes from 50 cents to 45 to 40 to 38 to 35, you physically start to get very emotional. I don't get that emotion with money. I don't feel that. So it doesn't bother me. I know the value is $1. I know it's worth $1. So seeing it go from 50 cents to 30 cents doesn't freak me out. If anything, I want to buy more or hold more or get more excited. And that's where people lose. That's where it kills people. They're very excited about this investment or this trade that they're making. They see it, they're in it, and then they lose 15-20%. It freaks them out. They lose everything, like they lose all trust, and they go on to the next one. So they just took a 15-20% loss. And then they do it again. They buy $1 for 50 cents. They're trying value investing. They're trying this. They're seeing all their friends making money with day trading, with options and this and NFTs and cryptos. And they're never allowing their investment to fully develop. And and you end up losing everything. I mean, you go from one to the other, to the other, to the other. You take 50% here, you take 50% here, you take 15% here, and you lose so much money. Now, and you think it doesn't work, and then you hate it, and you become so you're looking for excuses to hate, and you're just mad at the market. The last thing I want to say before we click play again is there was a study done by Joel Greenblatt, and long story short, it was like a hedge fund, and in the hedge fund, whenever they were performing the best, when they were at the peak and killing it, that's when the most people came into the hedge fund. Okay, so they were all coming in when they were performing well. When everything collapsed and went down or was slowed and everything was down, that's when the most people left. And it's supposed to be the opposite. You're supposed to come in and everyone's supposed to come in, and you're supposed to be greedy when everyone's fearful. So when everything's down, that's when you're supposed to come in, not at the top. And he saw this in the study. He also did this weird test where people were able to choose their own stocks and kind of do their own thing. And he realized that the people that the overall fund performed like 18%, I believe it's what it was. And even if they performed 18%, the whole fund performed 18%, majority of the people that took losses or like that were red were down 11%. How did that happen? How is it possible that the fund that picked all the stocks and all that stuff ended up with a 18% return on investment, yet everyone that was on the inside ended up with a negative 11%? Because they joined at the top and they got out at the bottom. Or when they were at the bottom, they freaked out and left, and they kept taking loss after loss after loss. I'm gonna have to make another video over that because that is a very interesting like talk over Joel Greenblatt and studies that he's made. And this is what I see happen. I've been in Discord groups. I've been on Telegram. I see people take small losses. I will look at like 20 stocks in like the 3 years, and they will all be up, yet people manage to take losses in them. And it's just insane to me. It's crazy. And that's just the psychology behind it. Anyways, enough about me. Let's go back to this.
Stock is going down, what am I going to do? So if you're buying a sweater and it goes on sale from $400 to $150, you get excited when you get to the store. But if you have a stock or you bought the sweater at $400, maybe you're not so happy. So I think for me, it's natural, but for a lot of people, it's fighting human nature. But it is true, it's what Warren Buffett said. When you find out about it, it's like being let in on this little secret. And so if you can remember that stocks aren't pieces of paper that gyrate all the time, that stocks are fractional interest in businesses, it all makes sense. So it's almost like you have to slow the game down, like they talk about baseball speeding up on you. You need to slow it down. I can buy this thing for a huge fraction of what it's worth. What am I worried about if it goes down a little bit more?
Okay, but so what's the gift here, knowing what it's worth?
So that's the thing. That's one thing that I always tell you guys. And I think I have a clip that I can probably play up with you guys off my phone. And I want you to hear this. So Monish Pabrai talks about premature accumulation, and he got that from Bruce Berkowitz. So Bruce Berkowitz founded the whole premature accumulation. Monish Pabrai caught on to that. Charlie Munger, other people, Seth Klarman. I'm telling you, Peter Lynch has told you, nobody catches the bottom. Almost every single stock that investors like us buy go down first. And it's impossible to catch the bottom. I talk about this all the time. You have to try and get out of that. And there's a video. Let me see if I can at least play the audio for you guys of him talking about this. I should have it here. Yeah, it's only like 10 seconds. So let me see. This is one. Let's see what this one was.
The way it should be. And I can tell you, I've been doing this over 35 years, and it's very rare. Almost never have I bottom ticked a stock, bought it at the absolute bottom. So 99.9+% of the time, a stock is down after I bought it.
So that is Joel Greenblatt. Again, another very infamous and famous and value investor, telling you that that's where people get hurt. And some of my biggest returns on my investments, the stocks went down a lot, like 50%, 30%. On average, I noticed that they go down 25%, 20%. There is times where I get very fortunate and I do catch the bottom, but that's not what I'm aiming for. That's not my goal. And there's one more clip I want to show you. Take a minute. I don't remember. Listen to this.
Number one, it talked about the best performing manager. I wrote it in 2011. So it talked about the decade 2000 to 2010. Looked at the best performing mutual fund, a study of the best performing mutual fund for that decade. That fund was up 18% per year, 100% long the U.S. equities. Market was flat during those 10 years, so 18% up a year is pretty good. Unfortunately, the average investor in that fund on a dollar-weighted basis managed to lose 11% a year. Because every time the market went up, people piled in. When the market went down, they piled out. When the fund outperformed, they piled in. When the fund underperformed, they piled out. And they took an 18% annual gain and turned it into an 11% annual dollar-weighted loss. Why? Well, to beat the market, if you're beating by 18 points, you're doing something different than the market. You're going to zig and zag differently. You can't do the same as the market. You have to do something different. You're going to zig and zag differently. Institutional managers.
So that's what I was just telling you guys. Okay, I'm so glad I had that in audio. That's what I was telling you about, and I see this. So I'm experiencing everything they've experienced and seeing, and I love learning, and I want to be able to share that with you guys about the studies and like how. Anyways, let's keep going. But now I don't need to explain it. I'm sure y'all get it by now.
I think that the analysis is actually the easy part. When I speak to business school students, I tell them investing is the intersection of economics and psychology. The economics, the valuation of a business is not that hard. The psychology, how much do you buy? Do you buy it at this price? Do you wait for a lower price? What do you do when it looks like the world might end? Those things are harder, and knowing whether you stand there, buy more, or something legitimately has gone wrong and you need to sell, those are harder things. And that you learn over with experience. You learn by having the right psychological makeup in the first place.
Well, stop.
So that is something that I always tell you guys. Like, for me, it's super easy to evaluate a company. I can do it in 2 to 5 minutes. I can go through 50 stocks and evaluate them so quick. It's once you actually have your top stocks or like your more favorite ones that you start doing more deep research into that it becomes harder. Like, should I buy? Should I wait? I keep it simple. I don't play games. Buy when the value is there with a margin of safety and sell when it's not. That's it. Don't play games. Don't speculate. Don't mess around with your money. Take this serious. Stick to the rules. If there's a stock that its fair value is $10, then you want to buy it at at $5. You want that 50% margin of safety. Sometimes you find them at 4 or 3. Buy. Don't try and guess. Oh, what if it goes to $4? What if it goes to 3? The value is there. Buy. Don't wait, because then what ends up happening is you wait and you're like, no, I'm not going to buy yet. I'm going to wait until it goes down more. And then it shoots up and you're like, man, I should have gone in. I'm such an idiot. Or you buy and it goes down and you're going to think, man, I should have waited. I'm such an idiot. You will never win because you're always going to look at the coulda, shoulda, woulda, or like the best case scenario. You're always comparing yourself to the best case scenario. And that's what kills you on the psychology side. And I don't see it that way. I don't care if I catch the bottom or don't. I don't care if it goes down first. And I'm certainly not timing when things would go up. So I buy $1 for 50 cents, and the moment it hits $1, or if it's on the way up, I find a better opportunity, I sell or switch. Let's go on.
What's the right psychological makeup that you have?
So
Patience would be one.
value
Willing to
investors have
sit on
to,
cash would be another.
value investors have to be patient and disciplined. But what I really think is you need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow up is because of leverage. And then you need to balance arrogance and humility. And I'll explain what I mean. When you buy anything, it's an arrogant act. You're saying the markets are gyrating and somebody wants to sell this to me and I know more than everybody else, so I'm going to stand here and buy it. I'm going to pay 1/8 more than the next guy wants to pay and buy it. That's arrogant. And you need the humility to say, but I might be wrong. And you have to do that on everything.
But
That is very key, is to have the ability to admit when you're wrong and just to have the humility. It's okay to be wrong. You're not perfect. No one's perfect. I'm not afraid to take losses. And I think that's something that also gets people. They're very afraid to take losses if they need to, or to accept the wrong, or to make a switch. Most of the time for me, it's not a loss. It's not like I buy a stock and it's down 50% and I sell to get another one. It's because I found a better opportunity with a bigger margin of safety that could bring me a higher return. And I'm not ashamed. I'm not afraid. I don't care what people think. I feel like I made a tweet a while back saying, like, do you care about making money or do you care about being right? And the difference between that is, if you care about making money, you do what's necessary. If you care about being right, you try and like portray you're some kind of person, and you don't want your friends to be like, oh my God, what an idiot. He took a loss on this stock, like your ego side. Okay. So that's just something I have to throw out there.
are you different than Warren in terms of how Warren has evolved and how you have evolved? Obviously, I think Charlie Munger had some influence on Warren in understanding to not just to look for the classic example, the cigarette butts, but to look at things that were reasonably priced with the belief that they could be, that there still was a margin of safety.
First of all, a lot of my Charlie Mungers are out here in the audience.
Yes.
So a lot of people here that I bounce ideas off of, and we share thoughts.
How have you evolved is my question.
Warren evolved
Is
from...
it different from Warren?
Warren evolved through 3 stages. He went from buying cigar butts and getting the last few puffs for free, to buying great businesses at really cheap prices, to buying and holding great businesses at so-so prices. And maybe even this new area of buying weird securities from crappy businesses at better than market prices, like B of A preferred or whatever.
That is stage 4, which I just discovered. I don't even think he fully realizes there's stage 4. Stage 1, you buy crappy businesses, unheard of businesses, or whatever businesses, small businesses, for great value. And they're quicker. You buy and sell. You're not holding them for a long time. You evolve to buying okay businesses, mediocre businesses for okay prices. You're buying $1 for $1 instead of $1 for 50 cents. And then you go on, I have to sneeze. I'm back. And then you go on to buying $1 for maybe $1.50 because you believe it's going to be worth $3. Once you have billions and billions of dollars, the needle won't move for you as much. So you just keep piling up on all this cash. What do you do then? You become a bailout god. You wait for them to come to you and you buy stocks, companies at better than market value because they need your help. They need you to come bail them out. Anyways, that's a whole different new thing. Let's go ahead and move on.
I'm still in phase 1. We're still buying We're still buying cigar butts. There's a good business there in buying them, and it's a lot of fun.
And that's what you're proud of.
No, I feel like I have stunted growth, Charlie. You know, you know what? I think Buffett's a better investor than me because he has a better eye towards what makes a great business. And when I find a great business, I'm happy to buy it and hold it. Most businesses don't look so great to me.
But he also doesn't, I mean, he is not really focused on the gyration of the stock every day.
Me neither.
You're not either.
I don't have a Bloomberg on my desk. I don't care.
You don't have a Bloomberg on your desk?
No.
Because you don't...
Mike makes enough.
What's on, yes, I know. But what's on your desk then? A phone?
Giant piles of paper that are at risk of falling on me at any moment, and I have a computer and a phone.
Yeah. So tell us about your desk.
Half-filled water bottles.
Yeah. I mean, but you sit at a trading desk. I mean, when you're not meeting either clients or people that are going to give you some information that might be relevant to what decisions you have to make, you're sitting at a trading desk.
Thinking big thoughts.
Are you really? Are you? It's not so much because you are reacting to the volatility of every market that you're invested in. Because if you are a value investor, my assumption would that you're not looking to trade at every moment.
We're not traders. There's a wonderful story.
Right.
Chris Brown at Tweety Brown tells a story of how they were interviewing somebody to come and to come join their firm. And after the interview, he's walking the fellow to the elevator. And the fellow says, you know, it's amazing here at Tweety Brown. At most firms, you can tell from the atmosphere in the place whether the market's up or the market's down. At Tweety Brown, you can't even tell if the market's open. And I think it's like that at our firm. We're making medium to long-term investments, 3 to 5 years or longer. And so we're not really that interested.
The only thing I can't agree there is the thing is that stage one is pretty big. And there's even more umbrellas under stage one, is the necessity of having to hold them for 2, 3, 5 years. At least from my experience, I think he just has a little bit more money to where he calls stage one, and he with a lot of money, but what's it called, that you can buy and sell in like a year or under a year. I've been able to find like 3 or 4 a year on average. So and I get to compound that. I go from 10,000 to 20,000, from 20 to 40, from 40 to 80, from 80 to 160, and you can do that. I think he's just like in a more towards the end of stage one, and I don't even consider him to be in stage one personally. So I think that's kind of where we have a difference. I think I physically see it, and I'm more based on the numbers and like the actual diagram behind it, which I've made on Reddit, and he's just kind of has the idea, but we're on the same page. It's all the same thing.
The only reason we care about the gyrations is so we can buy something even cheaper.
Do you like bad times then?
We benefit from volatility.
And distressed debt and everything else.
We provide liquidity when people want to sell things in a hurry. Presumably, it's a transaction between consenting adults. When somebody owns a bond that was AAA and now is CCC, they want to sell, they want liquidity. We sort of our rhythm is opposite most of the market's rhythm. We buy things when the market's down, we sell things when the market's up. Do I root for bad times? Of course not. I love our country.
I didn't mean it that way, bad times, but
is it frustrating when the market goes straight up and up and up, as it did from 82 to 87? It was frustrating, and I worry because just at those times, it's when the little guy gets sucked in, and the little guy finds it irresistible. When the market's going higher and higher, the little guy gets pulled in by stories from their neighbor, stories at the cocktail party, and they hear about how much money people are making in the market. Charlie, you probably know this, but the return from all mutual funds in the 1990s was 600 basis points higher than the average return from the investors in those funds during the same period. And that's because they get in at the wrong time and out at the wrong time. So that's painful to me.
So what is your lesson?
That's why I wrote the book, to try to educate the average person, but only like a few hundred of them read the book.
That's the one thing that we also all have in common. There's things that we will never share with people and don't share. And we just kind of like to keep it in our own little world, It's like when you find out about it, you want to keep it tight and nitty. I don't get a lot of followers. I don't get a lot of views. This probably won't even get more than 500 views. but it'll help a few of you. And he was the same with the book, and I'm the same way with what I share. Who knows when I'm going to stop making YouTube videos, when I'm going to stop sharing stuff. I'm growing at crazy speeds, but I want to share as much as I can. I want to move the next group into this and make you and help you guys make that.
I hope I'm going to get a copy of this book. But can you talk to us about your philosophy of timing? Is there no philosophy of timing? Because you're looking at value, and that you understand value, and essentially the big decision for you is the buy decision more than the sell decision.
Buying's easier, selling's hard
Right.
to know when to get out. There's no timing element. You can never tell how big a bargain you might get offered tomorrow. If somebody comes along and wants to sell you $1 for 50 cents, you can never know if they'll want to sell to you at 40 cents tomorrow. So you need to buy it and leave a little room to buy more, and maybe someday spend your last dollar and buy the bargain, and maybe it goes down before it goes up. So you always are checking and rechecking your work. The critical thing, the thing that would cause you to lose your confidence when you're doing that would be if you realized $1 wasn't $1. You thought it was worth $1, but Greece failed, or the euro fell or collapsed, and all of a sudden your dollar is only 30 cents, and now what you thought was a bargain is overvalued. So that's the dilemma. It's not so much figuring out what it's worth today, it's making sure it'll still be worth that same thing, or approximately that same amount tomorrow.
What's the biggest?
So a key thing there, that's why I always talk about consistency. Consistency is key. I like more consistency companies. That's a whole different talk, but I just want to throw it out there. And I bend the rules sometimes when it comes to consistency. Sometimes the company is moving. I guess I'll have to make a video kind of breaking down more rules and stuff, but if I have time, I'll do that in the future. I just happen to have a lot of time right now to make these videos, but I hope I'm guiding you in the right direction, and maybe changing your view in the market, and maybe you're starting to see what I see, and you start blocking out that noise, slowing down the market, and realizing this. I mean, let's keep going.
Mistake you ever made? Have you made it?
Coming here tonight.
Oh my God, after I prepared so hard? No.
I've been very fortunate. If you're talking about at work, I've never really screwed up a lot. We went through tumultuous times. We stuck to our discipline. We've made mistakes. They often are where we underestimated the leverage in the situation. We didn't think it was that big a deal, but leverage can magnify your returns, but also magnifies your losses. Getting in bed with bad people. We've had investments where...
See, these are interesting points, getting in bed with bad people.
Yeah.
How does that happen, and how do you avoid that?
So a lot of stocks are cheap for a reason, and often a value investor will figure out the reason because everybody else has gotten sick of a management raping and pillaging a company, overpaying themselves, deploying capital poorly, taking advantage of the shareholders with free stock or huge options awards, or hiring their brother-in-law. So there are stocks that have been perennially undervalued because they're run by somebody who fits that profile. A novice value investor will come along and say, well, that looks awfully cheap. And Graham and Dodd didn't really place the quality of management as high as they might have. And so good managements add value. Good managements have lots of levers they can pull. They can buy back stock when it's undervalued. They can...
So that is something that I'm kind of in that point. I don't necessarily place management at the very top of my list. It's at the bottom, but I do keep an eye on it. I do have to make sure they're not over diluting shares, that they're not screwing over investors, that they're not overcompensating themselves, paying themselves more than they should, that they care about the company. So I do look at it, but I don't. A lot of the times, like, again, it's a cigar butt. I just want that quick pump when everyone agrees or the market agrees, and I want to get out. So I don't necessarily care what happens in the future, but it all depends. Am I looking at a dying company? Am I looking at a growing company? How big is my margin of safety? How stable are they? How consistent they are? So that's a lot of variables, but it goes back to the whole blackjack thing. Having good management, having consistency, having a growing company, having a company with good percentage growth, revenue, and equity, both, and income. Obviously, all those things increase the probability of a stock going your way. I would put more money into a stock that is consistent and growing every year and has growing equity, and the fair value has been growing. Let's just say it's worth $1 right now, but then I see it going to $1.20, $1.50, $1.75, $1.80, and it's at 50 cents. I would even feel comfortable buying at 70 cents or 60 cents because that value is increasing, but I'm still buying it $1 for 60 cents or 70 cents. And I feel more comfortable. I feel more comfortable adding more money. I sleep better than a company that maybe is always, the fair value tends to stay flat at $1 and I bought it at 50 cents. Yes, it'll go up and it'll have its time. But I don't feel as comfortable. And then I feel the least comfortable, and maybe I'll add a lot less money into a company that is maybe a dying company. But maybe they have a couple years left, and it's kind of, I try and break down the company. I'm like, okay, let's try and break it. And if it's a lot harder, then there's enough room for someone to come in and buy them out, to merge them. Liquidating doesn't really happen these days anymore. Someone usually comes in, or they turn the company around. Someone else comes in, steps in, and they flip the company around. But yeah, that's just other stuff. And I think we're almost done with the video. There's probably like 10 seconds left.
Use the stock as currency when it's overvalued. Bad managements will think only about themselves first. And so those are early lessons, but profound lessons that I learned them well.
My mic was muted. So that's the end of the video. I hope I taught you something. I hope I opened your eyes and you see the doors and the path that I'm seeing, and you're seeing that the whole stage theory is not just bullcrap. You know, I'm not making this up. I'm not the only one seeing this. You saw Warren Buffett talking about evolving. You're seeing Seth Klarman evolving. You've seen Joel Greenblatt talking about it. You've seen me talking about it, and I'm living proof of it, working still to this day. And these opportunities are out there. You heard Warren Buffett talking about them. I see them all the time. Look at a stock like Gigam. Look at a stock like WSTL. Look at the 881 or 88604 Japanese stock. I don't remember the code. They exist. They're still out there. And that's the other beauty, that you can go outside the US. Anyways, it was great talking to you guys. Maybe I'll make another video of these. Make sure to like the video and comment if you like these videos, because you really tell me that you actually enjoy them. It helps the algorithm. Not that I actually make money off YouTube. I don't really get any views. And it just I don't know, it kind of hypes me up, I guess. And I see that some of you actually want in and want to know. I don't know. Peace. Wait, I have to end it on this side. Oh, this is awkward. I'm bad at this stuff.